Hello and welcome to the latest episode of Damien's Midweek Markets, the show where I talk about what's been going on in investment markets and what to look out for in the days and weeks ahead. Now, at the end of last week's show, I said the big story in the subsequent 24 hours was going to be the US Federal Reserve's announcement of its latest monetary policy decision. While no one was expecting anything drastic, there was always the chance if they did change something and surprise the market, we could have got a market wobble. Also, much depended on the Fed's rhetoric surrounding inflation, with some analysts even suggesting that we could see a spike in the 10-year US Treasury yield and it finally start to break higher out of its recent downward slump. Now, as it turns out, the meeting was a bit of a damp squib and passed by almost unnoticed by the market, with the Fed leaving its policy as it was, i.e. very easy. Now, if you recall, last time I also talked about technology stocks and that they were under pressure in the US, but they have since recovered their poise, with the Nasdaq 100 being less than 0.5% below its all-time high as I make this show. Now, following some weaker than expected employment numbers in the US, it looks like we could see the Nasdaq break its all-time high that it set last week. So we could see that record break today, but we'll have to wait and see. But while US tech stocks have recovered, Chinese stocks are still struggling. A rush of dip buying investors saw the likes of Tencent bounce 10% last Thursday, but it still left them with a lot of work to do to reverse the 20% drop they'd seen earlier in the week. Yet Tencent investors can't seem to catch a break at the moment, as its share price fell another 11% yesterday, back towards the recent lows of last week, after Chinese state media attacked the gaming industry, compounding the problems of last week and comparing computer games to the spiritual opium of the people and demanding restrictions be placed on the industry to avoid addiction among children. Now, hours later, Tencent announced it would limit the time children could spend playing its flagship video game, Honor of Kings, which was named in the state media attack and happens to be the world's top grossing game over the last 2 years. All of this was aimed at trying to stop the slump in its share price. It means that Chinese stocks are still under pressure and the divergence with the fortunes of US tech stocks continues. But it's not all doom and gloom in Asian tech stocks. The tech-orientated South Korean Kospi has rallied over 2.4% this week, having previously slumped alongside Chinese tech stocks. Now, a crash in tech stocks in South Korea has often been a precursor to weakness in US tech stocks, as we saw back in January and February this year. But the rebound now has been, well, perhaps a bit of a positive news for US tech stocks, but the relationship between the Kospi and the Nasdaq is not perfect. But overall, US stocks have been buoyant despite rising COVID cases due to the Delta variant. However, the 10-year US Treasury yield still doesn't share equity markets' optimism and has now tumbled to 1.14%, which is a 6-month low over concerns over economic growth. Now, having almost wiped out the move higher that we saw in the 10-year US Treasury yield from February when we had the reflation trade kick in, it does seem to spell the death of the reflation trade, at least for now. Now, the 10-year US Treasury yield remains an enigma for most people because the consensus view is that the yield should be much higher than it is at the moment. Now, we are back in a position where either the bond market is too pessimistic or the equity market is too optimistic about the economic recovery in the US. Either way, it means there could be some pain ahead for one of them. Now, keep an eye on the 4,400 level on the S&P 500, as from a technical perspective, it's proving a tough barrier to break through convincingly. Back in the UK, the FTSE 250 is still just shy of its all-time high, which is set last week, and the pound has rallied against the dollar. Having tried and failed to break the $1.40 level, keep an eye on this level, as it will prove pivotal to where it goes either higher or lower. Now, the strength of the pound has had a major impact on the portfolio returns you've seen over the last 6 weeks. A weak pound will boost in sterling terms the value of your overseas holdings, while a strong pound does the complete opposite. Now, tomorrow, the Bank of England announces its latest monetary policy decision. So it will be interesting to see what the impact on sterling will be. Any hint of an imminent rate rise could cause the pound to rocket through that $1.40 level, because the Bank of England is under pressure to do something about inflation. So we'll have to see what happens. So to sum up, there are a lot of moving parts in markets at the moment. And I'm going to be taking a 2-week break from this show because I'm going to spend some time with the family over the summer holiday. So it will be interesting to see how things resolve between now and then. And it could make for a very interesting show when I'm back. So that is it for this week. As ever, you can contact me. Damien at moneytothemasses.com is the email address. You can contact me via Twitter, money to the masses with a number 2, Instagram, Facebook, TikTok, and of course, do subscribe to our YouTube channel.